Have you ever wondered why some people seem to make money while they sleep, travel, or spend time with their families? It might sound like a dream, but for millions of Americans, passive income has become one of the smartest ways to build long-term wealth and create financial freedom. The biggest misconception is that passive income is easy money or that you need to be rich before you can start investing. The truth is much more exciting. Passive income isn't about getting lucky. It's about putting your money to work so it can generate more money over time. Whether you're earning $50,000 a year, building your first emergency fund, or already investing through a 401k, the principles are exactly the same. In today's video, we're going to explore how passive income from investments actually works, the best investment options available in the United States, the mistakes that keep most people from ever reaching financial independence, and the practical strategies that can help you build income streams that continue paying you for years. By the end of this video, you'll understand why so many financially successful Americans focus less on working harder and more on making every dollar they invest work harder for them. Imagine waking up one morning and seeing a notification that you've earned money overnight. Maybe a dividend payment arrived in your brokerage account, interest was deposited into your high-yield savings account, or a real estate investment generated rental income while you were sleeping. None of these earnings required you to clock into a job that morning. That is the power of passive income. While every investment requires some planning, research, and occasional management, the goal is to reduce the direct connection between your time and your income. Traditional employment exchanges hours for dollars. Passive investing allows your assets to generate income regardless of whether you're actively working. One of the biggest mindset shifts every investor must make is understanding that money is a tool instead of simply something to spend. Every dollar has two possible jobs. It can buy something today, or it can be invested so it earns more dollars tomorrow. Wealthy investors consistently choose the second option more often than the average consumer. Instead of upgrading every phone, buying a more expensive car, or financing unnecessary purchases, they direct a significant portion of their income into investments that continue producing returns year after year. This doesn't mean avoiding enjoyment or living an uncomfortable lifestyle. It means creating a balance where your future self benefits from the financial decisions you make today. Before investing for passive income, it's important to build a solid financial foundation. Many financial professionals recommend creating an emergency fund covering several months of living expenses before investing aggressively. This reserve helps you avoid selling investments during market downturns to cover unexpected expenses. At the same time, paying off extremely high-interest debt, especially credit card balances with rates above 20%, often provides a better financial return than investing because every dollar of interest you avoid is money that stays in your pocket. Once these basics are in place, you can begin focusing on investments designed to generate long-term passive income. Another important concept is compound growth. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, whether or not he actually said it. The principle remains incredibly powerful. When your investments generate earnings and those earnings remain invested, future returns are calculated on a larger balance. Over years and decades, this creates exponential growth instead of simple linear growth. Someone investing consistently over 30 years can potentially accumulate several times more wealth than someone who waits 10 years before starting, even if the later investor contributes larger amounts. Time is one of the greatest advantages an investor can have. Many beginners believe they need thousands of dollars before investing, but technology has changed the investment landscape dramatically. Today, many brokerages allow investors to purchase fractional shares, meaning you can invest with relatively small amounts of money. Automatic investing features also make consistency much easier. Instead of trying to predict the perfect time to buy, many investors use dollar-cost averaging by investing the same amount every week or every month. This approach reduces the emotional pressure of timing the market and encourages long-term discipline, which historically has rewarded patient investors far more often than short-term speculation. When discussing passive income, it's important to distinguish between growth investments and income investments. Growth investments focus primarily on increasing in value over time. Income investments prioritize producing regular cash flow. Many successful portfolios include both. Younger investors often emphasize growth because they have more time before retirement, while investors approaching retirement may gradually increase the portion of their portfolio dedicated to reliable income. The right balance depends on your goals, age, risk tolerance, and financial situation rather than following a one-size-fits-all formula. The United States offers one of the strongest investment environments in the world because investors have access to regulated financial markets. Tax-advantaged retirement accounts like a 401(k) and Roth IRA, publicly traded companies, exchange-traded funds, bonds, REITs, and many other opportunities. Understanding how these options work allows you to build multiple streams of passive income instead of relying entirely on one investment. Diversification doesn't guarantee profits or eliminate risk, but it can reduce the impact of poor performance from any single investment. Perhaps the most valuable lesson to remember is that passive income is rarely built overnight. Social media often promotes unrealistic promises of becoming financially free within months. In reality, sustainable wealth usually grows gradually through consistent investing, patience, and disciplined decision-making. The investors who ultimately achieve financial independence are often those who stayed committed during both booming markets and difficult economic periods. They continued investing through uncertainty, trusted proven long-term strategies, and allowed time to work in their favor instead of constantly chasing the latest financial trend. As we continue, we're going to explore the specific investment vehicles that have helped countless Americans build reliable passive income streams, how each one works, and how you can decide which combination may fit your own financial goals. As your investment journey begins to take shape, you'll quickly discover that not all passive income sources are created equal. Some are designed to provide steady cash flow, while others prioritize long-term growth with occasional income along the way. Understanding the difference can help you build a portfolio that not only grows your wealth, but also provides consistent income for years to come. The key is finding the right combination of investments that match your financial goals, your risk tolerance, and the amount of time you plan to stay invested. One of the most popular ways Americans generate passive income is through dividend-paying stocks. When you purchase shares of certain companies, you're not just buying a piece of the business. You may also become eligible to receive a portion of the company's profits in the form of dividends. Many well-established companies have built decades-long reputations for consistently paying and even increasing their dividends every year. Investors appreciate these businesses because they often produce stable cash flow and reward shareholders over time. Instead of relying only on the stock price to increase, dividend investors receive payments that can either be spent as income or automatically reinvested to purchase additional shares. Reinvesting dividends creates a powerful compounding effect because every new share purchased has the potential to earn future dividends as well. Imagine owning shares in several companies across different industries. One payment arrives from a healthcare company, another from a consumer goods company, another from an energy business, and another from a telecommunications provider. Individually, these payments may seem modest in the beginning, but over years of consistent investing and dividend reinvestment, they can grow into meaningful streams of passive income. This is one reason experienced investors often focus less on getting rich quickly and more on building reliable cash-producing assets. Of course, dividend investing isn't about chasing the highest yield. A company advertising an unusually large dividend may actually be facing financial problems. If earnings decline or debt becomes too high, management may reduce or eliminate the dividend altogether. That's why successful investors evaluate factors such as earnings growth, free cash flow, debt levels, and the company's history of maintaining dividend payments. A sustainable dividend supported by a healthy business is generally more attractive than an extremely high payout that may not last. For investors who prefer broad diversification without researching dozens of individual companies, exchange-traded funds, commonly known as ETFs, offer another attractive option. An ETF can hold hundreds or even thousands of different stocks, allowing investors to gain exposure to entire sectors or the overall market through a single investment. Some ETFs are specifically designed to focus on dividend-paying companies, providing investors with regular distributions while reducing the risk associated with owning only a handful of individual stocks. This diversification helps smooth returns, because the performance of one company has less impact on the entire portfolio. Many Americans choose low-cost index funds and ETFs because history has shown that consistently investing in diversified funds over long periods has often outperformed many investors attempting to pick individual winning stocks. Rather than trying to predict tomorrow's market leader, index investing allows you to participate in the long-term growth of the broader economy. As businesses innovate, expand, and generate profits, investors benefit from the overall strength of the market instead of depending on a single company's success. Another investment that deserves attention is the Real Estate Investment Trust, better known as a REIT. Traditionally, owning rental property required significant capital, ongoing maintenance, tenant management, repairs, insurance, and property taxes. REITs changed that by allowing investors to own shares in companies that own and manage income-producing real estate such as apartment complexes, shopping centers, office buildings, warehouses, hospitals, data centers, and industrial facilities. Because REITs are generally required to distribute a large portion of their taxable income to shareholders, they have become popular among investors seeking regular income. Think about how many businesses rely on warehouses for e-commerce deliveries, hospitals for healthcare services, or apartment communities for housing. By investing in REITs, you're participating in these real estate sectors without personally repairing roofs, replacing appliances, or dealing with late-night maintenance calls. Professional management teams handle the properties while investors receive distributions based on the trust's performance. Although REIT prices can fluctuate with interest rates and market conditions, they remain an important component of many diversified income portfolios. Another increasingly popular source of passive income is high-yield savings accounts and certificates of deposit, commonly referred to as CDs. While these options generally don't provide the same long-term growth potential as stocks, they offer stability and predictable interest income. In periods when interest rates are elevated, many Americans choose to keep emergency funds or short-term savings in FDIC-insured high-yield savings accounts, instead of traditional checking accounts that may pay almost no interest. This strategy allows idle cash to earn money while remaining accessible when unexpected expenses arise. Bonds also play an important role in passive income investing. When you purchase a bond, you're essentially lending money to a government or corporation in exchange for regular interest payments and the return of your principal at maturity, assuming the issuer meets its obligations. U.S. Treasury securities are widely considered among the safest investments because they're backed by the federal government, while corporate bonds typically offer higher yields in exchange for greater risk. Many retirees and conservative investors include bonds in their portfolios because they can provide more predictable income and reduce overall portfolio volatility. No investment is completely free of risk. Stock prices rise and fall, real estate values fluctuate, bond prices respond to changing interest rates, and even savings account rates can change over time. The objective isn't to eliminate risk entirely because that's impossible. Instead, successful investors manage risk through diversification, patience, and realistic expectations. They understand that temporary market declines are a normal part of investing and avoid making emotional decisions based on short-term headlines. By staying focused on long-term goals rather than daily market movements, they give their investments the opportunity to recover and continue compounding over time. As your passive income portfolio expands, you'll also begin to appreciate the importance of tax-efficient investing. Where you hold your investments can be almost as important as which investments you choose. Accounts such as a 401(k), traditional IRA, and Roth IRA each offer unique tax advantages that can significantly influence your long-term returns. Understanding these accounts can help you keep more of your investment earnings working for you, instead of unnecessarily increasing your tax burden. As your investment portfolio continues to grow, you'll realize that building passive income isn't only about choosing the right investments. It's also about placing those investments in the right accounts and following a strategy that minimizes taxes while maximizing long-term growth. Two people can invest the exact same amount of money in the exact same assets, yet one may end up with significantly more wealth simply because they used tax-advantaged accounts more effectively. That's why understanding retirement accounts in the United States is an essential part of any passive income strategy. If your employer offers a 401k, especially one with a matching contribution, it's often one of the best places to begin investing. An employer match is essentially additional compensation that goes directly toward your retirement savings. Failing to capture that match can mean leaving valuable money on the table. Contributions to a traditional 401k are generally made with pre-tax dollars, reducing your taxable income today while allowing your investments to grow tax-deferred until retirement. Over decades, that tax advantage can make a meaningful difference because more of your money stays invested and continues compounding instead of being reduced by annual taxes. Another powerful account is the Roth IRA. Although contributions are generally made with money that's already been taxed, qualified withdrawals in retirement are typically tax-free under current law. This means years or even decades of investment growth can potentially be withdrawn without creating additional federal income tax. Many investors appreciate this flexibility because it provides greater certainty about future retirement income. Depending on your income level and eligibility, combining a workplace retirement plan with a Roth IRA can create a well-balanced long-term investment strategy. While retirement accounts are excellent for long-term investing, taxable brokerage accounts offer flexibility for investors who may want access to their money before retirement age. These accounts have no early withdrawal penalties, allowing you to invest in stocks, ETFs, mutual funds, REITs, bonds, and many other securities. Although investment income may be subject to taxes, brokerage accounts provide opportunities to build passive income that isn't restricted by retirement account withdrawal rules. Many financially independent investors use a combination of retirement accounts and taxable accounts to balance tax efficiency with accessibility. Real estate is another asset class that has helped countless Americans generate passive income. When most people think about real estate investing, they picture purchasing a rental home and collecting monthly rent. While that can certainly be profitable, successful real estate investing involves much more than simply buying property. Investors must consider mortgage payments, insurance, maintenance, vacancies, property taxes, repairs, local market conditions, and tenant management. A property that appears profitable on paper can quickly become less attractive if unexpected expenses arise. That's why careful research and realistic financial projections are essential before purchasing investment property. Despite these challenges, well-managed rental properties have historically offered multiple potential benefits. Monthly rental payments can generate ongoing cash flow. Tenants may gradually pay down the mortgage, and property values may appreciate over long periods. Investors may also benefit from certain tax advantages available under U.S. tax law. Although individual circumstances vary and professional tax advice is often appropriate. When managed responsibly, rental real estate can become an important pillar of a diversified passive income portfolio. Some investors prefer an even more hands-off approach through real estate crowdfunding platforms or professionally managed real estate funds. These investments may allow individuals to participate in commercial or residential real estate projects with far less capital than purchasing an entire property independently. While every platform has its own risks, fees, and investment requirements, they demonstrate how technology has expanded access to investment opportunities that were once available primarily to institutional or high-net-worth investors. Another often overlooked aspect of successful investing is controlling emotions. Financial markets constantly react to economic reports, Federal Reserve announcements, corporate earnings, geopolitical events, and investor sentiment. During periods of market volatility, headlines can create fear that encourages investors to sell quality assets at the worst possible time. Conversely, when markets are soaring, excitement can tempt investors to chase overpriced investments simply because everyone else appears to be making money. Both reactions are driven by emotion rather than sound financial planning. History has repeatedly shown that disciplined investors who remain focused on long-term goals often outperform those who constantly buy and sell based on short-term news. Market downturns, while uncomfortable, have historically been temporary. Investors who continue contributing consistently during these periods often purchase more shares at lower prices, positioning themselves to benefit when markets eventually recover. This disciplined approach, commonly associated with dollar-cost averaging, removes much of the emotion from investing and encourages steady progress regardless of market conditions. Building passive income also requires realistic expectations. There is no investment that offers guaranteed high returns with zero risk. If someone promises extraordinary profits with little effort or claims, you can double your money in a few weeks without risk. That's usually a warning sign rather than an opportunity. Successful investors focus on sustainable wealth creation instead of chasing unrealistic promises. They understand that building financial independence is more like running a marathon than sprinting 100 yards. Perhaps the greatest advantage you have isn't a special investment strategy or access to insider information. It's consistency. Investing a manageable amount every month, increasing contributions as your income grows, reinvesting dividends, avoiding unnecessary debt, and allowing time for compound growth to work can produce remarkable results over decades. Wealth is often built through thousands of disciplined financial decisions, rather than one spectacular investment. As we reach the final part of this journey, we'll bring everything together into a practical roadmap that shows how an ordinary American can gradually build multiple passive income streams, avoid common investing mistakes, and move closer to lasting financial freedom while staying focused on long-term success rather than short-term market noise. Now let's bring everything together into a practical picture. Imagine two people who both start their careers at the age of 25. They earn similar salaries, live in the same city, and have access to the same investment opportunities. The first person spends nearly every paycheck as it comes in, upgrading cars, buying the newest gadgets, and assuming there's always time to start investing later. The second person enjoys life too, but makes one important decision every month. Before spending anything else, they automatically invest a portion of their income. At first, the difference between these two people is almost impossible to notice. After a year, their lives look very similar. After 5 years, one has accumulated a growing investment portfolio, while the other has very little to show beyond depreciating purchases. After 20 or 30 years, the gap becomes enormous. The difference wasn't a higher salary or extraordinary investment skills. It was consistency, patience, and allowing compound growth to do the heavy lifting. This is exactly why passive income should never be viewed as a shortcut to becoming rich overnight. Instead, think of it as building a financial machine. Every investment you make becomes another small part of that machine. A dividend-paying stock adds one gear. A broad market ETF adds another. A REIT contributes another source of income. Interest from a high-yield savings account provides stability, while retirement accounts like a 401k and Roth IRA help your investments grow more efficiently over time. Eventually, all of these pieces begin working together. Instead of relying on one paycheck from one employer, you begin creating multiple streams of income generated by assets that continue working even when you're on vacation, spending time with family, or sleeping. As your income increases throughout your career, resist the temptation to increase your spending at the same pace. Many financial experts refer to this as avoiding lifestyle inflation. Receiving a raise doesn't necessarily mean every dollar should be spent on larger monthly payments or more expensive habits. Increasing your investment contributions whenever your income grows can dramatically accelerate your journey toward financial independence. Even small percentage increases made consistently over many years can lead to surprisingly large portfolio values because every additional dollar has more time to compound. You'll also discover that successful investors spend more time managing their behavior than trying to predict the market. No one consistently knows where stocks will be next month, whether interest rates will rise or fall, or exactly how the economy will perform over the next year. Instead of making predictions, disciplined investors build diversified portfolios that can withstand different economic environments. They continue investing during bull markets, bear markets, recessions, and recoveries, because they understand that time in the market has historically been more valuable than trying to perfectly time the market. It's equally important to review your financial plan periodically. Life changes, careers evolve, families grow, financial goals shift over time. The investment strategy that made sense in your 20s may need adjustments in your 40s or 50s. Reviewing your portfolio once or twice a year allows you to rebalance your investments, evaluate your progress, and make thoughtful decisions without reacting to every headline or daily market movement. Investing should support your life, not become a constant source of stress. Remember that protecting your wealth is just as important as building it. Maintaining an emergency fund, carrying appropriate insurance, avoiding excessive debt, and staying alert to investment scams all play essential roles in long-term financial success. If an investment opportunity sounds too good to be true or promises guaranteed returns with little or no risk, approach it with extreme caution. Legitimate investing always involves some level of risk, and trustworthy financial professionals will explain both the potential rewards and the potential downsides instead of making unrealistic promises. Another habit shared by many financially successful people is continuous learning. Financial markets evolve, tax laws change, and new investment products appear every year. Staying informed through reliable financial news, educational books, and trusted professionals can help you make smarter decisions over time. You don't need to become a Wall Street expert overnight. Simply improving your financial knowledge a little each year can have a lasting impact on your future wealth. If you're just getting started, don't let the amount you can invest discourage you. Every experienced investor began with their first contribution. Whether it's $20, $100, or $1,000, the most important step is building the habit of investing consistently. Small amounts invested regularly often outperform large amounts invested inconsistently, because successful investing is driven by discipline rather than perfection. The ultimate purpose of passive income isn't simply accumulating a larger bank account. It's creating choices. It means having the freedom to retire with confidence, spend more time with loved ones, pursue work you genuinely enjoy, support causes you care about, travel without constant financial worry, or simply experience greater peace of mind knowing your money is working alongside you instead of depending entirely on your daily effort. Financial freedom looks different for everyone, but passive income can become one of the strongest foundations for achieving it. As we wrap up today's video, remember that every successful investment journey starts with a single decision. You don't need to predict the next stock market winner, inherit a fortune, or earn a six-figure salary before you begin. Start where you are, invest consistently, diversify wisely, take advantage of tax-efficient accounts like a 401(k) and Roth IRA when appropriate, reinvest your earnings whenever possible, and allow time to become your greatest financial partner. Years from now, you'll likely discover that the most valuable investment you ever made wasn't in a particular stock or fund. It was the decision to begin. Thank you for watching. If you found this video valuable, make sure to like, subscribe, and turn on notifications so you never miss future videos about investing, passive income, retirement planning, and smart money strategies designed to help you build lasting wealth in the United States. I'll see you in the next video.